Basically, when Joe Biden is threatening to effectively end shareholder capitalism, he's really saying he's going to end individual ownership and the profit incentive. You see, the notion of shareholder capitalism really comes to us from none other than the late, great Milton Freeman. He wrote about it in 1970 in an article published in the New York Times. At the time, there was this huge debate over whether corporations should serve the interest of the shareholders or should serve other interests. Dr. Freeman's article made it pretty clear that shareholder capitalism was best for society. And they dealt with questions such as whether a company ought to lower prices to help offset inflation, even if it meant foregoing profit. Just as an example, can you imagine if Walmart decided to sell things below their actual cost? Wouldn't that be good for society? Of course it would be good in some respect, but Walmart would go out of business, and that would be bad for society. From the election of Ronald Reagan in 1980 and over the past 40 years, shareholder capitalism has been the dominant theme of corporations in this country. Now, of course, companies should follow the law, and of course, corporations must maintain a good relationship with society, or they'll lose their customers, they'll lose their employees, and they'll harm shareholders. These are givens of an admittedly imperfect system. Sometimes it goes astray one way or the other. But plenty of companies have benefited by being ethical economic citizens and serving society at large while still making a profit. These companies attract a good labor force and appeal to more customers. That's the basis for shareholder capitalism. The problem comes when managers of corporations determine to manage companies for some primary purpose other than to get a good return for shareholders. The theory sounds well and good, but the practice quickly leads to disaster in multiple ways, mostly because it rejects free market principles. There are real-world examples where restaurants choose to benefit customers at the expense of owners. They let the customer pay whatever they would like to for a meal. Started as a gimmick, but eventually these restaurants always fail. Panera Bread tried it, and it failed. It even happens in China. I'm going to quote from Business Insider. Earlier this month, in an effort to attract more customers to her new restaurant in China, Lu Zhengzhong had a noble yet ill-advised idea to let walk-ins pay whatever they wanted after finishing their meals. While one would hope that the pay-as-you-want policy might spark an outpouring of generosity, in reality, people are walking out with garbage cans full of food, and the promotion resulted in a massive $15,000 loss for the restaurant. You see, if it doesn't work in China, which is already a communist country, do you think it's going to work here? And yet, that is what stakeholder capitalism would promote. There's also examples where the primary purpose is to increase employee wages. Sure, you want to serve customers, and hopefully you want to make a profit, but when the number one objective is to pay employees the most possible, failure is inevitable. Even the $15 minimum wage in Boston was more than almost a 200-year-old restaurant could handle. And it should be noted that the idea of keeping prices as low as possible for customers is mutually exclusive with the notion of paying employees the most possible. The same is true for just about any other goal you might propose. All of these are good societal goals, but you've got to balance them, and the only real balance comes from the free market. By focusing on profit, a balance is struck. Wages have to be high enough to attract workers. Prices have to be low enough to attract customers. Owners want to make profits, and then they can donate some of the profits they make for social good. Governments get a share of those profits. That's the taxes, and those taxes pay for government services. Free market competition provides opportunity for all and keeps the system running. Of course, society has an interest in preventing monopolies. They have an interest in making certain that products and services and workplaces meet safety standards. In our system, those are handled by laws, regulations, and the potential for private litigation, as well as the free market. In other words, society sets the rules, and the role of corporation is to operate within those rules to maximize profit following those rules. There are, of course, threats of fines, imprisonment, and costly litigation if the rules are broken. It's not perfect, but it has proven successful over time. Corporations that damage the environment can be sued. Harmful products are either regulated away or the market suffocates them. People won't invest in companies that are at risk of continuing lawsuits, but all of these functions depend on free markets and profits.